Okay, today we are going to talk about VC funds, venture capital funds. We are going to discuss kind of how they work, what purpose they serve, what their interests are, how their managers get paid and make money, and what kind of companies they're interested in, and then the dynamics of how they make investments. This is meant just as an introduction. It's a fairly complex subject, and they come in all shapes and sizes. But it's very important as an entrepreneur to understand the motivations of a VC fund and what they're trying to do for their own investors and how the individuals that operate them make money, so that you don't have any confusion about why they might not be interested in your company, why they might be interested in your company, and then how they make money. So sometimes some of the operational decisions they make don't seem to make sense in light of the company, but it does make perfect sense in light of how VC funds operate and how they are paid, how the partners are paid. So let's start talking about the basics about what they do and how they do it. So what is the goal of a venture capital fund? Well, number one, it's to make money. They are for profit. So they're trying to make money. They're also providing what's called growth capital. So growth capital means if a company is poised to go through dynamic growth. Oh, by the way, this is early stage VC funds because they come in all shapes and sizes. So we're talking about very early stage. If a company is poised for dynamic growth and can grow a ton and in a scalable way, those are the kind of companies that VCs are investing in. And what they're trying to do is, create jobs and drive innovation and build economic structure in the community. But really, they're trying to make money, and they're doing that through investing growth capital in small companies. It's important to understand, though, that the type of company that they invest in is only one type of company that exists, and we'll talk about why after we go through sort of the parameters of how they operate. So how much money do VC funds manage, and how much do they have to invest? This varies greatly, but early stage funds will be anywhere from 25 million, say, all the way up to 150 million. Okay, and that's the total fund size. That's important to understand because when you look at what typical size investment they make, then you can tell sort of how many investments they can make in total. This money is raised from investors of their own, which we'll talk about in a second, and they're trying to provide a return on that money. So you should, by the end of this, you should understand the dynamics of how that return works. So let's look at a typical investment size. Again, there's a range here as well, but this could be anywhere from $1 million to $3 million. And higher, sometimes even as high as 5 in the opening round. And beyond the opening round, venture capital companies will often participate with their portfolio companies, meaning they'll put additional money in. So over the life of a company, you may get 8 to 12 million invested, but that comes in various rounds if they need it. But the typical first round size would be somewhere between $1 million and $5 million. So this is a lot of money going into these companies. I mean, you have to have an idea that's big enough to warrant this much money coming in. So if you're starting a daycare center in your home, this is not an appropriate form of investment. So given that they do $1 to $5 million investments, and they might range between 25 and 150 million, let's look at a $150 million fund that does on average $5 million first round investments. But remember, they're going to allocate 8 to 12 million over the course of the company's life. So what does that mean? How many times does 12 million go into 150? You're looking at between 10 and 15 investments. Okay? And if these have 3 or 4, if the venture capital fund has 3 or 4 partners, and those are the folks that manage the fund, they would each sit on between 3 and 4 boards. So they'll make 10 to 15 investments per fund. The duration of those investments will be between 7 and 9 years, sometimes longer lately. But really that means that you've got between 7 and 9 years to get to your exit point so that they can realize profit. We'll talk about how those dynamics work. But this is important because they can't operate with you indefinitely. They can't spend money and let you run your company for 20 years. That's not their model. They're going to need to get out, meaning sell their shares and leave the company within this amount of time. However, this is a lot longer amount of time than a lot of other types of investments, so they really are a partner with an entrepreneur over time. That being said, they're more interested in the survival of the company than they are of the entrepreneur in particular, because they just need the company to be worth something in order to sell their shares. So there isn't necessarily any loyalty to the entrepreneur in particular. They will often fire entrepreneurs if the entrepreneur is endangering the health and welfare of the company. So participation, what does that mean? So that means, when do they put money into these companies? The A round is obvious. That's usually where they come in, is the first round. But then they may do a B and C round as well, where they'll put additional money in over time. And that's important because they want to maintain their ownership percentage, or sometimes increase their ownership percentage if things are going well in a company. So what is the expected return that these guys like to see? The expected return for these guys is going to be 10x plus. They won't really consider a company a success unless they get 10 times their money back. Often, when you have huge venture deals like Google or something that's wildly successful, they'll get between 50 and 100 times their money back. So this can be hugely lucrative if you have one company that really succeeds. And ultimately, when we talk about this later, that will be their strategy, is that they're trying to get a few companies that grow extremely quickly, and others may die. But as long as they get a few of those big returns, that may make their fund very successful. I wrote down these terms: preferred stock board seat and restricted stock purchase agreement, because VCs are fairly sophisticated investors, and they will often have many and somewhat onerous terms in order to give you this huge amount of money as an entrepreneur. So learn what these terms are, and learn each of these terms as well. If you're considering pitching a VC, you've got to know what a liquidation preference is and what drag-along rights are. And we have individual videos that explain these. But these are very important because they tend to either give the VC a financial advantage or solve some sort of risk, mitigate risk for the venture capitalist. And I won't go into each of them in detail, but understand that when a VC invests in a company, very, very often these terms are included. Always they will demand preferred stock, they'll demand at least one board seat, if not more, and there are almost always reverse vest founder shares through the use of a restricted stock purchase agreement. So get to know what those things are.